Fixed rates have started to rise, and this is bigger than just a bank changing their numbers because they feel like it. This could be the first real sign that affordability is getting worse before it gets better. And whether we like it or not, this is the clearest signal that the banks have actually sent us on where they think interest rates are going in the near term. And if you're a first home buyer, this could be the final moments before the window shuts right in front of your eyes. So in this video, I'm going to break down exactly what is happening, why it's happening, and how you can stay ahead of the curve and get yourself into your first home sooner rather than later before time starts to run out. So let's do a little bit of a recap on the news. The Westpac Group this week has increased their 2-year fixed rate by 0.35%. All of a sudden, a notification went out across the industry, giving us all notice of the change, bringing it up from 4.99% to 5.34%. This is significant because it is very closely matched to where the current variable rates are in a competitive market. And now, while I was making this video, I was going to make mention of the domino effect that is going to happen in the market. But in the meantime, I did check a few fixed rates, and Macquarie Bank has increased their fixed rates as of the 13th of November from 4.99% for a 2-year fixed rate to 5.29% for a 2-year fixed rate on an 80% loan to value ratio. And where do I think this is going? All of the major banks are going to start increasing their fixed rates because all of them get their funds from the same place. And usually when one bank moves, the rest will start to follow. So there are 3 key metrics that influence the bank's fixed rates, and it's not just the RBA's cash rate. It is in fact the cost of funding, market expectations, and inflation. Number 1 is that the cost of funds is starting to rise. So a bank needs to buy money before they go ahead and lend it out to the public to go buy their homes. This is through a few different channels. One is the Reserve Bank. We have bond markets, 3 and 5 year swaps, and also retail and wholesale funding from different sectors. When the cost of that money goes up, fixed rates have to rise because they need to lock in some sort of profit margin to make sure the banks are still running at a reasonable profit for the shareholders. Another big one is market expectations. If the bank is expecting money to become cheaper, then they will reduce their fixed rates ahead of time to try and lock some customers in, so as rates start to decrease, their profit margins then increase on those fixed rate products. Now, when they don't think rates are going to come down as fast as they once thought, they start to raise up the fixed rates to mitigate a little bit of risk because some people have actually fixed onto those rates for the 2 and 3 year terms that they were offering. So right now, this tells me that the market expectation is that we're not going to have any more rate cuts for the rest of 2025, even though we only have a month and a half left, and very little, if any, rate cuts at all through 2026. So there's quite a few more things that go into actually making up a fixed rate than just the RBA's cash rate. And the one data point that shocked a lot of people around Australia was the inflation data that came out recently. The RBA's forecast was way off in this instance, and the banks have started to readjust their expectations on where they think the interest rate market is going to go. Fixed rates usually move a lot faster than the Reserve Bank of Australia. When we were seeing rates decreasing, we had banks lowering fixed rates a lot faster than the Reserve Bank. Now, with all of the new data that's at hand, they've started to raise them that little bit, which shows me where the market expectation is. So now that you've gotten through that part of the video, what does it actually mean for someone like yourself? First of all, borrowing power isn't going to be changing much at all. When rates stay the same as they are, your borrowing capacity can't really increase because that is the main lever we can pull to be able to increase your borrowing power and in turn buy a more expensive property. This can then push up prices quite quickly. But the interesting part of all of this is that prices are still rising in certain market segments. And this I'm seeing happen a lot in the first home buyer market. Since we've had a lot of changes with the first home guarantee, a lot of people are actually choosing to buy their first homes, which is why we're seeing such competitive markets under the price thresholds in each state. So that just means the gap is widening from where you are now to where you want to be when buying your first house. Melbourne's median house price at the moment is rising $15,000 to $20,000 per month. The average savings rate, $1,000 to $1,500 per month per household. So if your borrowing power is remaining flat and not improving, what do you think that's going to do to your chances to be able to buy your first home in the middle of next year? You simply cannot catch up to a market that is moving faster than your savings, especially if we are not getting the significant wage growth that we so desperately need to be able to afford these more expensive homes. But it is a vicious cycle. Very simply, waiting gets more expensive every single month. If you are ready to go ahead and buy yourself a property right now, the government is not doing much to increase the supply of homes. So when we have a limited supply and very high demand, especially in the first home buyer market, prices will continue to increase regardless of what interest rates are doing. The changes to the first home guarantee increase the amount of people that can actually buy in those segments. So let's be real. Everyone that wants to buy and can buy is starting to think about it and is already starting to take a lot of action, which means momentum in this market is building quite quickly, especially in that first home buyer segment. So in Victoria, the threshold for the first home guarantee is $950,000 and below in capital city areas. I have seen firsthand how incredibly competitive these properties are to actually purchase because there are a lot more people that are now eligible to access the low deposit scheme, and they are being very competitive when it comes to buying. And let's not forget about the investors, because they've been sitting on the sideline for a little bit of time now, and a lot of them have some money in some property that have built up equity and they're looking to go again. We're also seeing couples combining their incomes and buying together because two incomes obviously is way better than one. Investors are also back in force as well. With extremely low vacancy rates, we have seen 40% of new lending in the most recent quarter be investor lending, which is a lot higher than usual. Another little factor that not a lot of people talk about is inheritances, and early inheritances are making a massive impact on the market. I've had so many conversations with clients getting early inheritances from their parents to be able to buy property because they can see where these prices are actually going. So let's not get mistaken. People who can buy are buying. And if you think you can buy or you want to buy, you should be getting a move on pretty quickly. So what are all of these switched on first home buyers doing? They're getting their borrowing capacity checked again because it has been changing over the course of the year. They're getting pre-approvals in order now because there are a lot of properties coming onto the market towards the end of 2025. They're tightening their budgets and increasing their savings because as we increase our savings, we can then leverage further if our incomes can allow for it. There's also a lot of people exploring the option of rent vesting as well, which is where you buy an investment in a location you can afford and continue renting in an inner city suburb. The smart ones are mapping out their timelines because they know supply is not going to be easing anytime soon and demand is going to continue rising. And despite what interest rates are actually doing, people will continue to buy property. So I encourage you to understand exactly what you can and can't do because a lot of people are already ahead of you. So the banks have shown where they think interest rates are heading in the near term. If you're waiting for interest rates to continue to fall so you can increase your borrowing capacity and buy something a little bit better, this is something that is going to be outdated very, very quickly. I personally don't think we're going to be getting any interest rate cuts across 2026 because I simply do not think the economy is in a position to do so. Thank you, and don't forget to subscribe.